Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, September 28th, 2023. It is 3:12 p.m. Eastern Time as I'm starting this video, and I'm going to just do a quick update that I can hopefully get out to you by the close. And I'm just going to hit on the main things that I've been talking about now. I'm not going to go into individual sector stocks, but the primary asset classes, which are stocks, commodities, really via the precious metals in this one, and crude oil. Definitely want to update that, and probably should do nat gas as well, and then Treasury bonds. So those are really your main asset classes: stocks, bonds, and commodities. So let's dive into the charts. This is the 5-minute chart I got out to you this morning. First posted this in the comments section below this morning's post. Made it clear yesterday, closing all my index shorts and going long, and then going even longer this morning, for lack of a better word. Adding to those longs right after the opening lows, and so that's where we were today, right here. And gave you this chart here that shows the how I'm planning to game the the squiggles here. Arrow breaks denote potential price targets, and each one would help firm up the case for a rally. So my first level was at 356.76. I had us going up to about 359.70. We'll call that about 360. Obviously with a reaction. That's what arrow breaks are. It denotes a reaction. And let's see where we were. So 356.76. That was this morning. Here we are now. Couldn't have played out any easier. There's the breakout of three. That just highlighted the gap here. Let me take that out. I didn't have that in this morning's chart. So there it is. There's a breakout. The fact that we just blasted off shows that it was a significant level. It wasn't just some random arbitrary level. Got you right up to where the first target was, where you could have, as an active trader, like I like to do, turn around, reverse that, came a pullback, and the pullback came right back to the breakout point. That's the first resistance level. We traded down through the gap. That was just a small gap here, not the big. This is the big gap I'm still looking for a move up to. And so now what you have, and this is the live chart, by the way, you have this uptrend line that's formed off the lows. That's what we pulled back to, and you pulled right back to your resistance. Once broken, then becomes support. So this was an objective level to get back into longs, and should it play out the way I think it will. Now we go up. We already checked. We already had the initial reaction off the at 360-ish level there, and so that should open the door for a thrust up now to that 361, about 362-ish level there, the bottom of that bigger, much more significant gap. You can see at the volume price histogram bars here. This is where it's really thin. And should we enter the gap and backfill it, it's really thin all the way up here. If you look at the histogram bars, volume of price histogram bars, it's really thin all the way up to about this level here. There's obviously, you can see the other resistance level. So, and again, this is just micro analysis, 5-minute charts. Trade it as you want, don't trade it as you want, do whatever. But the what it does is helps to firm up the case for a more significant rally off the daily charts, the more significant daily charts. So this was at T1, first target, support, August 18th lows. All this covered earlier. I just want to say it's playing out. Let's not even dwell much more on this, because again, I've covered that quite a bit lately. I made a comment. I'll probably do that in this video. Let me make a little note to go through some of my comments, because there were some good questions, and I made some replies. And one of those is, I trust this market about as far as I can throw it. There's been a lot of sell signals lately, sectors and key stocks, and even indexes breaking down. And so I'm long and strong at the moment, and told you earlier, I will flip on a dime if something doesn't smell right or feel right. As of now, again, this is bullish price action, 110%, and on the daily chart too, not just that little 5-minute I started with. So let's move on. That's so far so good on that. And again, a lot of those stocks, Apple coming off positive divergent low, moving back up. Microsoft divergent low. Still a little work to be done. Oh no, Microsoft popped it. It popped that downtrend line, so that was that buy signal there we were looking for. Okay, this is all. I don't want to be redundant. Covered all this stuff. Let's go to the next stuff because I have quite a few questions on the metals and the miners. And so, gold gave you an official trade idea the other day on it. Just yesterday, and these are your bounce targets here. So T1 is going to be up here. Now this trend line may come in. I might tweak this trend line a little bit. Yeah, it should and can be tweaked. It's a downtrend line off the recent highs right there. But either way, these are the targets, and it's still down today. Now, as I mentioned, and I was mentioned in the comment sections that I made, in the comments that I made today on the homepage under some of the posts, silver is my preferred proxy, and the miners. That's what I'm long. I went long. Took silver, added to that today. Took it yesterday, added to the miner. Started a position in the miners today, and I'm going to get to that in 1 second. So there's gold. So far so good. 60-minute chart. Again, I shouldn't say that. So far so good. My bad. I'm sorry, guys. It's down today, but I still like it, and it's going to need to rally for silver and the miners to rally. But let's look at the other two. Silver SLV. If you're an ETF trader, silver's got some really nice support here. Let me find a clean board and mark it up. I've been trading the futures, so that's what I have marked up already. Just massive support right here. You can see going all the way back into June. Well, let's count them. 1, 2, 3, 4, 5, 6, 7, 8, 9 reactions, on or around this level, about 20, 51, $20. No guarantee it'll stick or hold, but it's a wash, rinse, repeat thing. Last time I highlighted that level was right here, and we had a bounce. Divergent low, divergent low, bounce, divergent low, bounce, divergent high, get out, short, divergent low, and then that started setting up support. At that point, you can see we had several reactions, and another one, divergent low, rally, divergent high, correction, divergent low, bounce. And we're back there, and it's an equal low, so all I have to do now is extend this line, extend that one out, and then put one right here. It's, again, equal. Maybe we punch down a little bit. You can allow a stop a little bit down there in case we do punch down, but again, the case can be made, in my opinion, to be long gold and silver in the minor. And this is what it looks like on the futures, SI. Same thing. Obviously, it's tracking silver. We had a divergent low back here, just to the left of the chart. The divergence lines were divergent low. See, this has been support for a while. Divergent low and divergent low. And again, you can say this is really just the same divergence from back here, like I just did on SLV, the silver ETF. Extend that divergence, and it gives us an even larger divergent low, and the potential for a much larger rally that could easily take us back up and above these previous highs from those last divergent lows. So, and that's, again, don't fall in love with it. Stop. That's what stops are for. You may want to give it a little room. Your stops might be tighter than mine, or they might be more liberal than mine. That's depends on your risk tolerance and really where you think it's going. At the end of the day, stops should be commensurate with your projected price targets, ideally using a 2-to-1 or better risk-reward ratio. All right, let's move on to palladium. Palladium is another one, and then I'll get to GDX. Throughout palladium, about a week or a couple weeks ago even, was it? And still like it very much. And somebody asked for an update just the other day, a couple days ago, asked for an update on palladium, which I posted on the homepage. Here, let me see if I can pull that chart up. Okay, here it is. That was on the 26th, so 2 days ago. And I said I still very much like it. Palladium's back testing the downtrend line. That's this right here. That was where the setup was. Breakout there, breakout back test. And I still maintain these targets. It's another one of the precious metals looking good. That was 2 days ago. And again, that's why I always encourage you to check the comment section from time to time. Come in, and that's where I'll post updates and things like that. So that's it. 2 days ago, you could have bought it there, and on the back test, when that was posted, or if you're following it, you should be following this yourself. This is the same pattern that I laid out back here, And so, it's already up about 5% in 2 days off that back test. Now it needs to obviously take this out, these recent highs, and that should open the door for a move up. I have a minor resistance level right here, but I'll just keep these targets now: T1, T2, T3. So that's palladium, and so all in all, looking good. A lot of my optimism, if you will, on the metals has to do with the euro US dollar pair. Talked about that just yesterday, coming down to my long-term support level right here. Should it continue a little lower, I have the bottom of that big support zone, major long-term support resistance zone, not too far below. So I think it's imminent before we get a decent tradable bounce in the euro, and possibly it's possible it just started. We've had divergence building forever and a day on the 60-minute chart. You can see here, from back here, these indicators making higher highs, prices making lower low, or the euro making lower lows. This is kind of a busy board here, a messy chart, but that's it. So and again, this ties into what I said this morning. The euro, and which is inverse to the dollar. You can use the dollar or use just the dollar, US dollar. You have an inverse relationship to the gold, silver, and the stock market. But bottom line is, with the euro being the biggest component of the dollar index, the euro rallies, especially euro US dollar pair, means the dollar's falling, and that is tends to be bullish for gold, silver, the miners, and also for the stock market. So that should help the miners as well. So that's it. They are all interrelated. The euro, US dollar, stock market, gold, silver, and all that. All right, let's check that off. Oh yeah, GDX. I did tell you GDX. Okay, here's the miners. Miners. You got this divergence right now. Extend that divergence. We've been building. Most significantly would be right here. I might have a cleaner board. It's right here. It's starting to really steepen, if you will. The indicators, momentum indicators, are making higher highs against these lower lows and prices. Let's see. This is what it looks like on the 60-minute chart. We had a divergent low here, but this has been support here, and we're testing. This is a pretty key level right here. And again, the miners, the metal rally, the miners will likely rally as well, and you still have potential target zones up here. I often say the miners are simply effectively, if you will, not actually, but effectively a leveraged play on gold, because when gold goes up X, they go up some factor of X. Whether it's 2 times, 1.5, depends on market conditions, but it will usually, the miners usually rise and fall along with gold, but more so in percentage terms, and silver as well. That's why silver is usually my preferred trading proxy of the actual physical metals when I'm bullish on gold. Okay, next up, let's talk USO. We've started to break down today on the 60. If you recall from the other day, I laid out some targets here. I actually laid it out as a trade idea back here. And then the other day I said you have to recognize this downtrend line. If they pop it, I can see a scenario of a marginal new high. If it does, it will still be a divergent high, and that's exactly what we got. Now, divergence in itself is not a sell signal, but we did fail back below that previous high. So that breakout there has failed. There's a gap that's being backfilled. And again, this is big divergence, and I suspect that we'll go on down just like we did at this divergent high. And it could be a more significant top. If it does, if we do see falling oil prices, that should help support a stock market rally. But if for whatever reason we're in some blow off top mode and crude oil has more to go, there is some resistance right here. I had right around where we just ran into. That goes all the way back here. You had a lot of reactions there and there. And so again, if we happen to just have some kind of melt up top, that's not going to be good for the stock market. The stock market has already, we're pushing the red line. We have been, and I've been talking about this with interest rates, with the 10-year Treasury yields, and with crude oil, and the things that have the biggest impact on the economy. And that, again, of all commodities, crude oil by far the most significant for inflation. And then, of course, interest rates. So, and that segues into my next thing. So, That's it, guys. I am, long the equity markets, long the metals and miners, everything I just covered, and short crude oil. And then I gave you the Treasury bonds the other day, ZN. You can use the 30 if you want a little more juice. I'm just trading the 10 right now. That's IEF for ETF traders. And I did give you some targets on that the other day, I believe. Was it on this board? Where did I give you those? Oh, maybe it was on the futures. Either way, we still have that divergent low. And yes, the 10-year broke out recently, as I talked about. But it's a breakout that I think will probably fail soon. And at this point, looking for a pullback. But if we break that primary uptrend line, that's going to have, that's in red here, that would have a longer term bearish implication for rates, which would be bullish for bonds. Rates fall, bonds go up, and we're only a hair above that level. Again, this is unsustainable. The market has been playing, the stock market, I keep saying, has been playing a game of chicken with interest rates, not believing this move. Rates are higher than they were when the market bottomed back in October of 2022. So something's got to give here, and that means we're either going to have to see this to support further gains, or even to keep stock prices where they are. In my opinion, you'll have to see this. If we get this, especially with crude prices going up, this market's just going to crack. The bottom's going to drop out of it. And then whatever divergences we have on the 60-minute chart, and all those support levels we just hit today and yesterday that I highlighted, will get taken out, and we'll have a big leg down. So possible. I'd like to think that I'll flip around and get positioned accordingly. If so, when that happens, I'm watching this. It's not a day or a minute. I don't take my eyes off the Treasury bond yields and everything else I'm watching. But as of now, like I said, you can make a case based on the 60-minute chart. This is the yield here. I was back on IEF a second ago. Big divergences, positive, aka bullish divergences. Probably get a reversal here. So that's it. I remain long and bullish Treasury bonds, long and bullish stocks. And remember, stocks and Treasury bonds, and this happened back in when the bear market, or when it started last year in late 2021, early 2020. And that's what blew up a lot of, or really put damage, I should say, on a lot of pension funds and hedge funds and the old 60-40 diversified model that worked so good for so long, meaning when the stock market fell, bonds usually went up and vice versa, but everything fell together. And so we still have, at least as of recently, there's been that positive correlation. You can just simply see it by turning on comparison to the S&P 500. Most recently, this is where, as I warned it would, for a while there, the stock market was going up. That's the S&P 500, and remember, this is not the yield. The yields are opposite of this. So rates started to rise right here, and that's why I said the stock market will get the memo, and it got the memo right here, and then it started to follow bonds down, meaning interest rates have been rising. So the only way we're going to see the stock market rally, in my opinion, is if bonds rally, which means rates fall, and they may not. So like I said, and I continue to repeat myself, I am cautiously bullish right now and ready to flip around or take profits if and when the charts tell me. And that's why I cover all this stuff, because if this continues, if the 10-year bond continues to fall in price, and that means yields are going up, and the longer it happens, the longer that disconnect between equity prices and interest rates, I think the more powerful the mean reversion will be and that will be the stock market coming down hard. So as of now, let's watch this. If we can get bonds to rally, it means rates are coming down, and that should help at least provide a tailwind for the equity markets. All right. Well, all that in 19 minutes. So I'll just hit on natural gas and we'll wrap up. Somebody asked the other day too, and I think I just updated this about update on UNG, and I said they asked if it was a no man, so I said no, it's at the bottom. Still is. This is the bottom of this trading range. I don't have a strong opinion on it, but I can tell you it's been working so far. You just buy the bottom of the range on right here. This is a little sloppy, but you can see for the most part this is the range here, and The MO is to, you know, sell the top of the range. Sooner or later, it'll break one way or another. I don't, at this moment, I don't have a position or a strong opinion on it. And so I just figured I'd do an update because there's been a few questions on it. The things I like I said earlier, at the moment, equities and precious metals, euro, that whole, and it's all, by the way, too, that's a correlated trade. So although it sounds, if you talk to, you know, any financial advisor on the street, say, oh my God, you're super diversified. You have Treasury bonds, you have gold, silver, you have stock equity, S&P 500 or QQQ. No, I just went over the fact those are all correlated. So chances are I'm going to be right on all of them or wrong on all of them. And so keep that in mind with your position sizing. The one that I said, well, that kind of changed. It was the other day I said when I was still short stocks until yesterday that I went long Treasury bonds as potentially an indirect hedge. But that's no longer the case because, you know, I'm long both right now. So scratch what I just said. Anyways, just take that point to mind, that to be long those completely different and normally unrelated asset classes is not in current market conditions because of their correlation and how they're trading in near lockstep with the dollar and the euro. All right, and let me wrap it up here, get the video out to you guys, and hopefully in time for the close. This has been Randy Finney with Right Side of the Chart. Have a great day.